Welcome to Coffee and Keys, where we blend our expertise and personal experiences to unlock your awareness of the real estate industry.
They're the best.
Here they are.
And now, here's your hosts, Darlene, Kemp, and Jacques.
Welcome back.
Welcome back. Another podcast.
Another one under our belt. I'm telling you, we're getting better and better.
Yeah. They're coming along. And again, I think it's nice that we always try to say, hey, we'll really want to focus this on what is the listener going to get? How can we help? How do we want to, again, we're not here to have them do a deep dive educational, thing. We just want to give them some basics and help them through the process. So it's not so scary, right?
Right.
We believe in homeownership. So yeah. So today's topic is.
Today's topic is, how do I know I don't qualify? And how we got this topic was a conversation between you and I, like off camera. And we were kind of laughing at me when I purchased my first home. Yeah. And I remember sitting in front of the loan officer apologizing because I had such a high number, because I had no idea what a credit score was. I just know it was time to buy a house. I wasn't even in real estate then. Right? It is. And so then the loan officer says, okay, well, take some information for my husband and I. And so the loan officer comes back and says, okay, so you've got a 720. And I was like, oh, I am so sorry.
That's good.
I go, we have a lot of debt. And the loan officer is looking at me like, okay, you got something else to tell me?
You don't know what you don't know, right?
You don't know what you don't know. So you and I were laughing about that. Yeah. I mean, now, hindsight is 2020. It's funny. Yeah. I was so serious sitting in front of him and saying, I'm so sorry. So, that's just one, aspect of credit. But the topic is, how do I know I don't qualify?
Right. There's really only one way to find out if you do qualify or not, is to kind of go through the process. And again, a lot of people think that this process is big and scary and, oh my gosh, I'm going to go out there and, put my heart and soul and somebody's going to, judge me or what I say is treat it as, it's never too soon to start this process to figure out where you're at, whether you're going to buy now, 2 months from now, 6 months from now, a year from now, whether it's 2 or 5 years from now. I mean, this is something I actually think they should be teaching in school, when people are figuring out how to live life, because let's face it, your credit affects everything you do, not only buying a house, but it affects your price on insurance, on car notes, on any type of loan, on credit. I mean, your credit score is a number that really just says how risky you are to the lender, right? That's pretty important.
So you hit on a couple of things here, actually. You said that, it depends, your credit score depends on the price that you pay. So that goes to interest is added to the price every month, correct? I mean, you take the interest.
Yeah. Yeah. So we'll start with a simple question of, okay, what is credit? Right? So what is credit? Credit basically is where you're going to borrow money from somebody, typically a lender. Mm-hmm. And why is the lender going to lend the money to you? Because they not only want their principal amount, the amount of the loan, which they call the principal balance, they don't only want that loan money back, but they also are going to make interest off of that loan money. And that's their profit. So the reason they're going to lend credit to you is so that they can get their principal amount back plus interest. And their interest, again, is their return on their investment. So, why does anybody invest in anything? They're investing for that return on the investment, right? And the higher the risk, the higher the rate.
Right? So that's how you end up paying more for something when you're a higher risk.
Yep. So, and a credit score is just one thing that they look at to see how risky you are. And it's all, we're all what we call creatures of habits, right? So, and that's kind of what they're looking at that credit score is how have you done in the past? Because they assume that that's how you're going to do in the future, right? So their credit score is just a way of looking at how you've paid back your credit in the past versus and with the assumption that that's how you're going to continue. If you've been late on everybody you borrowed money from in the past, more than likely you're going to be late. If you've gotten collections and judgments, which means they had to come after you in order to get the money back, or, charge-offs or whatever, where they've never even gotten the money back, then they're going to be a little less likely to lend to you. And if they do lend to you, it's going to be at a higher rate because they're taking a high risk, right? So that's kind of what your credit is only a part of what we look at, but it's a big part of what we look at, because within that credit is how in debt are you, right? What are you have going out monthly in bills, but also how are you paying those bills back? And that's what your credit score is based off. But we don't expect anybody to be perfect. We're all human. Right?
We've all had those bumps in life, right?
Yeah. I always say life happens to us all. If it hasn't happened to you yet, just wait.
That is true. It'll catch up.
It will. I mean, so we've all had seasons in life where, things may have gotten a little difficult, illness or loss of a job, all those things that you pray never happens. But, every once in a while life does happen. And we're okay with that. What we're really looking at is, are you out of that situation? Have you come back? So when life happens, the seasons go through, let's say you lost your job or something like that. And the only way that you can come back is had to do a bankruptcy, and it's one way that you can kind of use and wipe the slate clean and start all over again. And a lot of people think that if I do that, I'll never be able to buy a house. Well, there's a time frame to that, but
that's a big word.
Yeah,
that's a big word.
But there's seasons, and it doesn't mean that you'll never be able to lend you again. Now, if you do a bankruptcy, it will stay on your credit report for 10 years. Most derogatory credit stays on your credit report for 7 years, with the exception of bankruptcies. They stay on your credit report for 10 years.
So it doesn't mean you cannot buy a house, correct?
No.
Okay. There's just
Each
a few
loan program's
rules.
Different. Correct. So depending on the loan program, depending on the lender, depending what you're buying, it's just going to depend, on how fast you can get back on your feet. So, government loans after a bankruptcy, think, well, if you've, been able to reestablish credit and stay clean for 2 years after your bankruptcy, after you've wiped the slate clean, then you may be able to buy a house after that, So just depending on those loan programs. And some bankruptcies you don't do a complete liquidation. You just, come up with a payment plan, get back good with your creditors. And once you've done that, there's no waiting period on most loan programs for that one too. Just have to make sure that if it's not discharged, you get permission from the court.
Right.
And even if it hasn't gotten that bad, let's just say you have some late payments and all of a sudden your credit score drops drastically, right? So how do you get your credit score back up? What are some things that you can do? And those are things that we can just walk each borrower.
Well, you're an expert in that. I mean, you are. You are. You've done that with a couple of my clients that I sent to you. Now, I am not a lender. I sell homes, but I get the lender questions from my clients.
Right.
So, I know the basic answers. I know enough to get me out of trouble. Those answers.
Right. But and credit is a part of my job, and we have some tools that we can use to really kind of help the borrowers. And, again, we'll start with what is the credit report. And that's something that we're talking about. Credit is basically anything where somebody's lent you money and you're paying it back and, that kind of thing. But that credit report is the reporting agency. And there's 3 main credit bureaus that we use. So we use Equifax, Experian, and TransUnion. So we pull what's known as a tri-merged credit report. So from credit report from all 3, which is going to show your history on your payment history. It's going to show all your opened accounts. It's going to show any closed account in the last 7 years. It's going to show if you've done any bankruptcies, that kind of thing. It's going to show, late payments and things like that, and how long ago they were and how many. Are they 30 days late? Are they 60 days late? Are they 90 days late? So it's really kind of showing that history there as far as how you're paying back your credit.
Right.
And then it's going to come up with a score. It has a certain algorithm that it uses, right?
So each credit bureau uses a different algorithm?
Yep. So when we pull all 3 credit bureaus, you may get 3 credit scores, 3 totally different credit scores.
I always wondered about that. Why are they different? I got the same credit. I'm one person.
Different bureaus are using a little bit different algorithms. And not only is it going to be a different score per bureau, but you're going to get a different score depending on what you're shopping for. In other words, a lot of people say, well, I got my credit score. It came in on my credit card bill. Well, it might be 800 here, which is awesome. But then, I pull it and I'm not quite that at 800. I might be 760. And they'll say, well, why is that? Because each industry uses a different algorithm. So if you
So they measure it differently?
Yeah. So if you play with Credit Karma or your credit bureau, or your bank, gives you a credit score or something, they're going to base it on whatever you're purchasing. If you go out and buy a car, you may have a different credit score when the car dealer pulls it. But as an industry, when I'm pulling it as a mortgage company. So any mortgage company that pulls it, we're going to pull the same score because it's using the same algorithm. So you don't have to go to 10 million different lenders to find 10 million different rates. It's going to be the same information that pulls, right? For say a mortgage company, but it may not be the same score as what you're seeing on like a Credit Karma or what you're seeing if you just applied for a car. Not only that, your credit score is something that is a living, breathing thing. Every day it changes. Because what affects your score is maybe the length of credit. Let's just say you had a bill that, you just paid off and all of a sudden, that's reported today. So that could change what your score is. Or let's just say you made a charge and now your high credit limit is closer to the high credit limit and your score might drop a little bit. So your credit, score is something that's kind of a living and breathing thing. And we just hope that they're all treading in the right direction and treading up, right? But several different things will affect that credit score, such as the types of accounts you have, like a revolving accounts. A revolving account is like a credit card where it's an open-ended loan to the bank. So you have
use
like
it every month.
Limit. You can use it every month. Yep. So it's like a credit card or a line of credit on the house or whatever. So you have a certain high credit limit, and then you can borrow against it and pay it back, and borrow again and pay it back. And those are one of the accounts that we can really use to help boost somebody's credit score up. Because they're going to base that credit score based on your high credit limit to balance ratio. So in other words, if you have a $3,000 credit limit and you've got $2,999 charged, it's almost maxed.
So that's not a good thing.
It's not really a good thing. And the minute you go over that credit score, then it'll really drop your score because you've exceeded what the bank has agreed to lend you. So if you took that same debt and then paid it down to maybe a third of what your credit limit is, it's really going to help boost your credit score. So those are some things that we can look at when it comes to credit scores. And they're going to look at the different types of credit you have, installment loans, secured loans. Secured loans are loans that have something backing them, like a house is a secured loan or a car note is a secured loan. And because they're secured, a lot of times they're lower interest rates because they're secured, because they're not as risky to the lender, right? To whereas credit cards are usually higher interest rates. Some of them, look at your credit cards, everybody. If you're just, some of them are prime plus 10. If prime is 8.5, you're paying 18.5. Some credit cards I've seen as much as 23 and 27%. When you buy something,
what is a prime?
That's a lot of money.
What's a prime?
Good question. The prime rate is what most banks lend to their prime customers. So when you hear about, the Federal Reserve coming in and changing interest rates and things, one of the things that they're doing is they're lowering their interest rate, at the interest rate that they lend to the banks. And then the banks use that rate to figure out what other loans that they're going to give to you, because the banks make money because they borrow it at one interest rate and then they lend it to you at another one. And the difference to that is their profit.
Okay. So when you say prime plus 10,
so if prime today is 8.5%, you'd be paying 18.5% interest rate on a credit card.
And so who assigns that 10? I don't like that person. I don't.
Revolving accounts are very risky, especially, I'm hoping, if anything else, every borrower out there will go open up their credit card and find out what the interest rate is.
Because everybody's paying that prime. The prime is the same for every credit card. Is that correct?
Well, it usually is affected by the prime interest rate plus a margin. Okay. So depending on the risk factor, how risky is that borrower? Where's their credit score? That'll determine how much higher you're going to be. A prime customer is somebody who is, squeaky clean. They got lots of money in your bank and they're, not a risk to you. So you may only charge, prime plus 3 or 4 or 5. But most credit cards are prime plus 10 or 11 right? And then some department stores are even higher than that, 24%. So yeah, I mean, when you think about it that way, our 6% interest rates on mortgage loans are really good.
They are really good. So let's fast forward to the question that I get all the time because, I get this buyer, some of them are afraid to hear what you may say, when you pull that credit,
Intimidated. Yeah.
intimidated. But, I say, well, you have to do it. I mean, you have to, we'll deal with whatever's on the other side. Let's find out what's on the other side.
Yeah. And I like to tell everybody that it really is a personal thing. So it's not like, if you come to me and I'm going to help you through this process, I always say, give me all the pieces to the puzzle. Let's tell me the whole story, right? Let's and by pulling your credit, I'm only going to see the half the story, and then I'll come back and I'll ask you some questions based on that too.
Right.
Now, again, keep in mind that credit is only one piece of the pie here.
So it's
but
not
without
the
a good
same.
credit score, it won't. You may not be able to buy, but there's loan programs out there. I mean, FHA will lend as low as 580. Again, not every 580 is going to get approved, because it's really going to depend on all the other factors. The first-time homebuyer programs, 620.
But every buyer does not get the same interest rate, correct? And I ask you that because I get the buyer that says, well, she quoted me, let's just pull a number out of the air. She quoted me 6%, but my sister is only paying 4%. So why? Why do I have to pay 6%? My sister's paying 4%. And so not everybody gets the same.
Correct. And again, there's a lot of reasons for that. We all basically are looking, mortgage loans and interest rates are based on the trading of mortgage bonds for that day. But then
for the day,
borrower for that, because it kind of. I don't know if you've seen the stock market tickers that change every day. So the mortgage bonds kind of change every day. Yep. So we all are. Mortgage companies are looking at the trading of mortgage bonds to figure out where those mortgage interest rates are going to be. Kind of anticipating, by the time you get the loan and close on it, what the actual market interest rate is for that. So they change daily. Number one. Number two is, when I get that price sheet, there's what we call add-ons for the risk. Remember, higher the risk,
so
higher
you
the
could
rate.
be a higher risk.
So yeah,
that person could be a higher risk than their sister.
Correct. So totally different. If I get somebody who's at a 620 credit score, they're a little bit on that lower side. They really probably don't either have a whole lot of credit history, or they may have had a couple lates, or they're, a little more maxed out on their credit cards. There may be a couple of reasons why that's a lower score. And then you've got somebody over here that's got, a 780 credit score. And they've got a lot of different credit. They've got a good credit history. They've been paying debts back on time. And, so with a higher credit score, they're less of a risk. With a lower credit score, they're a higher risk, which means then there's a higher rate. There's certain add-ons to that based on that credit score. So, that, and then that's only one of the add-ons. Well, what if the sister put 20% down and you only want to put 5% down? That's going to affect your credit score. Yeah. The higher the risk, the higher the rate. If you're putting 20% down, it's not as risky, right? If you're only putting 5% down, or if you want, with one of the first-time homebuyer programs, 3% down, it may be a little bit risk. The higher the risk, the higher the rate that's going to be on there. So there's a lot of things that are going to affect that interest rate. So credit is one of the keys, right? But it's not all of them as far as what you're going to do there.
So that's pretty interesting, and that is a common question that I get. I'm like, okay, so your sister may have better credit,
Yeah, or timing. I mean, right now we're looking in the market where a couple of years ago people were paying 3% and 4% interest rates. Oh
yeah, there were some at 2.
Yeah.
I think I had one. Yeah, 2.25. You got me 2.25 back then. Yeah.
So and today that same borrower with the same terms might be looking at 5.75, 6, just kind of depending. So it really just depends on the market. It's going to depend on the risk factor of the loan. It's going to depend on the type of loan, how much money you're putting down. That's all going to affect what that rate will be. But the first thing anybody should do is just have a conversation. And I always say, if you give us all the pieces of the puzzle, then we can break it down to figure out which loan program fits you best based on what you're looking for, right? Because when most people are looking for a home that they want to qualify for, there's two really things that they need to know. How much money do I need out of pocket? And what's my monthly payment going to be, right? And the lower the interest rate, the more they can buy with our money.
Right.
So,
That's true. The less you're paying.
Right. So, and that means the more house I can buy.
Right.
The lower the credit, the interest rate, then the more house that I can buy if I get qualified for a certain payment. Right. So those are some of the things that we look at is kind of what's important to you. How much money do you have to work with? Where do you want your payment? And then obviously we'll pull the credit and kind of take a look at that. But then we're also going to look at income. I mean, that's a big factor there too, because we're basing how much we qualify you for based on a percentage of your income. And again, each loan program is a little bit different, right? And again, when we talk about risk, if you got the income and you only want to spend 30% of your income towards housing, that's great. But if you want to kind of push the level and go up to 45% towards housing, a little riskier for the lender when they're having more of your money going into just housing. So we're going to look at the housing expense ratio, and then we're also going to look at your housing and debt ratio there. So we're going to take a look at pull your credit report and say, these are all your debts on your credit report. Here's all your income. And if you want a house for this amount per month, we're going to run all those ratios to make sure you qualify there. And one of the things we can do, and that's why it's never too soon to start this process, because if you've got somebody that says, well, I'm in a lease, I got a year to go, they just want to know what's the next step. Right. And it's really the best way to find out what the next step is. Let's look at your income and let's look at your debts. And we can play some what if games too. Well, what if I paid off this credit card, or what if I did this? Hey, well, if you do this, we can raise your score by this many points. That's going to help you get a better rate. Or then also, if you paid this off, then that's a debt that we don't have to count against you in qualifying. And, this is how much money you have. What's the best thing to do with that money? Is it better to put it all down as a down payment? Or maybe we should buy some points and buy the rate down permanently? Right. Or maybe I should take that money and pay off a debt that's at 27% and, get a little less down payment on the house, but I'm getting in debt free or something like that. So those are some of the puzzle games that we can play, and it's never too soon to really have that conversation. It's not just yes or no, you qualify. Right. And I think a lot of people, that's what their fear is. They're like, okay, I'm going to call this lender up and they're going to say, no, I don't qualify, or yes, I do qualify. And this is how much for. It's more of making sure that you're talking to somebody you can have a conversation with. Okay, well, this is what I'm really looking for. This is what I want to do. How do I get there? And then we can walk through that process with them.
I think we've got two clients right now that we recommended that they continue to rent for another year. But then you said, work on this, pay this down, pay that down, and then we'll kind of revisit this in 8 months, so I kind of check in with them.
Yep. And actually I have, a lot of the clients that we've recently done some transactions with, I've been working with over a year. Just kind of, well, number one, they may not find something right away. Right. Now I am a strong believer, as you never know what tomorrow's going to hold. Today's always the best day to buy a house. Right. So
the best time to buy a house was 5 years ago. That was the best time.
But again, that really kind of depends. Were you ready? It wasn't the best time if you weren't ready.
That's true.
Or, if you had sometimes you just kind of look at the whole picture and the bigger picture. Yeah. But if you weren't ready 5 years ago, it wasn't a good time. But if you're ready now's always the time to buy. Yeah. So, and there's credit is one of those things that I think a lot of people get fearful about. No, I don't want you to pull my credit. Oh no, don't do that. And I'm thinking, it's the best way that we can help you is to pull it and see it. And then we can, again, we have some tools. We can do some what if scenarios. If you paid off this or paid off that, and kind of figure out what we can do if we do need to raise your score. But most people really don't even know what that score is. And that's the other thing too, is it may not always be the same wherever you're looking at it.
Yeah.
Right?
Yeah.
So we pull from TransUnion, Equifax, and Experian. We use that
But you use all three. You don't just use one.
We pull all three, but we throw away the highest score, we throw away the lowest score, and we use that middle credit score. And that's the score that we base your rate off of. So if you've got like one score that's
lowest, okay.
Yeah, so if you got one score that's like a 640 and one may be a 660 and one may be a 680, well, we're going to throw away the 680 and then we're going to throw away the, 620, and we're going to use that 640, and then we're going to use that middle one at that 660. That's the score we're going to use to base your, scores off for the program. So that's, normally what we do. So if we're trying to raise your credit score, we may have to raise both two bureaus in order to get the credit score that we want to get when we raise that. So that's usually the biggest thing. And anybody can take a look at their credit report, and I highly suggest that everybody does. You can go to www.annualcreditreport.com, and you can pull a free credit report from each bureau and kind of take a look at it and see what you have on your credit so that ahead of time. And that's, then because there could be something on there that's wrong. I highly recommend people take a look at the credit and pay attention. If somebody's reported you a late payment, make sure it's late, or call the creditor or find out what's going on. Or if somebody's got a collection on you and you didn't even know about it, you might want to double check and
that's
look
happened.
at that.
Old utility bill you haven't
forgot to turn in my cable box.
Yeah. Here's a question for you. I had a client, and you know who this is, that he took it upon himself to go to another lender to see if he qualified to purchase a home. And this other lender ran his credit, and I would think that he would have the same credit score all around, ran his credit, and the lender came back and says, you do not qualify to purchase a home. So he kind of went home and, kind of forgot about it. Well, a couple of months later, because he was a renter, the landlord reaches out to him and says, hey, I'm getting ready to list this house. So we're going to need your help in showing it, your cooperation. So he comes to me frantic and he says,
I don't want to move.
I don't want to move. I'm getting ready to lose the place that I live. And I said, well, why don't you consider buying it? Let's see if you qualify to buy it. And he said, I don't, because I went to a lender a couple of months ago and they said I don't qualify. So I always have hope. It
never hurts to get a second opinion. I've always said that. It never hurts to get a second opinion. You don't know what they looked at, what they saw, what they did. It never hurts to get a second opinion, especially if they didn't educate him on what he needed to do in order to get qualified.
I don't think he did anything different, honestly. Yeah. He had no hope. So, at that point, I called you and I said, hey, look, can you take a look? I'm going to have him call you. Can you take a look at it? Look, he's already been there he's already been there 2 months ago, and he was told that he doesn't qualify. So here's his number. You could either touch base with him. He's got your number. He'll call you. So you did. You reached out to him and you called me back and you said, I can do it. And I about fell out of my chair. I was like, there is no way. Now, same credit score, same situation on paper.
We don't know that because it was a couple months ago. So I don't remember exactly what his credit score was when they pulled it.
Okay.
But then again, and I think we did have to do some little tweaking on him as far as debt to income ratio and some things like that. But he met our loan guidelines, and
he lives in that house today. Still.
And he loves that house. Yeah,
he loves that house
several times. Yeah, he's so glad he didn't get kicked out of that house.
I know. Well, he made it hard for them to show while he was qualifying. I was like, you cannot. Yeah. I went over to his house. You cannot do that.
But it's a good thing he did because he got in. But
he got in.
And that's why I said, if anything else, if you get a no, then try to understand why.
Right.
What are the guidelines? What guideline am I missing? What do I need to do? It's not I always say it's not a no. It may be not now. Once you do this, that, or the other, then we're going to put you in a position where you can. But no is not forever. Right. It's just a not now. It's not a no. And so, unfortunately, that lender probably didn't give him that warm and fuzzy that no, you can't. Instead of saying, well, no, but if you do this, that, or the other, then you will be able to, or, and again, program guidelines, it's a way of, I always tell everybody, as far as I think of my job. Most people understand the attorney aspect, right? And the legal aspect, and you see all that on TV. So you have an attorney that represents a client, right? And they're representing them based on the law. And then they have their paralegals that help them with the paperwork and all that other stuff. And then you have the judge. And when they go to court, this attorney, makes the case in front of the judge, who is the one who rules based on the law, right? So in the mortgage industry, I think of myself as part of that attorney, where just give me all of the information and I will make your case for you, and we'll bring in front of the underwriter the things that show them that you meet the guidelines and, you obeyed the law, then that's what you can get, approved for. So it's my job to understand what those guidelines are that those underwriters are ruling off of. And I may have some paralegal and people in the background that are helping me pull paperwork and documents and all that kind of stuff there for me as well. But really it's about making a case. And so, when the borrower comes to me, it's like, okay, well, I'm going to look at it this way. And I think if we do this, that, or the other, this is how we want to put this loan together. This is the type of loan that I think you should get. And, then I think we can get you approved based on this, right? So now we can pre-approve them based on that particular loan program. And I say, if I have all the pieces of the puzzle, there's tons of different loan programs and ways that you can get people qualified.
Right.
So,
right.
Credit's only a part of it, obviously the income. And like I said, and if you're not fitting in a particular box right now, then we can say, okay, this is what you need to do next. And you come up with a plan, and then you work with them so that they can eventually get qualified, So yeah, I said, it's not a no, it just might be not now, but we're going to try to put you on a path where you can.
So there's a way to tweak it. There's a way to, kind of fix it or, turn it just a little so that you do qualify. And there's been simple steps. I mean, you've called me and said, hey, look, it's not now, but all they have to do is just pay this off. And sometimes it's not even pay off. You've said,
just pay it down.
Pay it down.
Yeah.
You don't have
Get
to
it down
pay
to this
it
balance.
off.
We can rescore you. Once we rescore you, your score will meet guidelines. You've got all the other, things in there, meet guidelines. And some of them may say, okay, well, look, you don't have enough, save up a couple months of reserves. With a lower credit score, they want to see some money in the bank. Again, it's all about risk and layering that risk. And so, it may be just be saving up a little bit of money to meet the reserves. It may be, paying some of the accounts down. You don't have to pay them all the way off, but you pay them down, it brings your score up.
Right.
And some of them, you really want to look at the job history too, right? So, if you've only been employed for 6 months, might have to wait for you to be, they're usually looking for 2 years full employment. We can count schooling there, but they're looking for 2 years of employment in the same line of work. So we're going to look at the whole picture and then advise them based on what we see. And our goal is to get, everybody into home ownership. Yeah. And what I always, I really want to take the fear away from it. The other thing to let people know is when you come to me, it's kind of client privilege. It is. So just like in the attorney, what you tell me, is between you and me.
You don't even tell me. I'm like, come on, Darlene, come on, tell me. And you're like, I cannot tell you.
No. And if we have to have certain situations, like they need to pay off this, and then I can get permission from the borrower to explain to you, so you can help. You're helping in the process, or let's say they don't have quite enough money, but you might be able to negotiate some closing cost in there. You might be able to negotiate. So those things that, I can get permission from the buyer, because you're representing them, to be able to come up with a plan between all three of us, so that when you're out there showing them houses, I say they qualify, however they qualify, but especially on VA loans, I love it. They qualify, but if you get a seller to pay this debt off for them, then they really qualify for this, so we can play that puzzle game only on VA loans though. But so let's say somebody only has so much money, but, if they put a little bit more money down as the down payment, then they can qualify for more or for another different program or something like that. But they don't have enough to do the extra down payment and closing costs. So now if you can negotiate closing costs, which again, I know it's market driven. Right.
Yeah.
And I know it's really, kind of
But there's always a way to get, I've never had a problem with trying to, get it if we need it. Yeah. But
maybe not this house. Maybe this house isn't their house if they can't get this seller to do it. But then you'll find them a different house that they can. And, so it really is working as a team to make sure that they can get what they're
That's what we do. That's what we do. So unless my client tells me, what debts they have, or how much they make, I have no idea.
No idea if
I
they
have
qualify
no
or not.
idea. All I know is, I send you to your lender, and your lender, talks to you and tells me if you qualify. That's it. And what you qualify for. And if we need closing costs to make it work. And, that's all I know. I know a lot of clients of mine think that I know how much they make. I have no idea. None.
Right. Yeah. And again, it's kind of that, I think that's what they get so intimidated about. They're coming to me and telling me everything, but it's between me and them, and we're going to come up with a solution for them, and come up with a game plan and figure out, a map to use, right? So that they can get into something. And then, then that's when we hand them back to you, and you go.
And then we do our thing.
Houses and buy, yeah. So, it shouldn't be intimidating, and it doesn't cost anything. And here's the other great thing: a lot of people think, "Oh my gosh, I don't want to be obligated to something. Why? I don't want to talk to her because then I'm." There's no cost or there's no obligation. You don't sign anything contractual with a lender. You're signing disclosure. You'll sign a lot of things, but they're protecting the lender that we told you these things, right? We have to disclose what the cost is going to be and all that kind of thing. So you may be signing authorizations to pull credit, authorizations to do electronic signatures, authorizations, and then just, hey, by law, I have to give you this disclosure within 3 days. Make sure you sign it so you acknowledge that I've given it to you. But there's nothing in there that's contractual. In other words, you can tell me to go jump in a lake anytime you want to. Until the day of closing, when you lend you the money, then you're signing the contract.
We've had one of those.
So once you've got to the closing table and you've borrowed the money and you are signing a contract that then you're basically signing a deed of trust that says, if I don't pay, I don't stay. So. Right. But other than that, you shouldn't be intimidated by the lender. What you should be doing is using that lender as a educational piece for you to help get you to where you need to go, and find somebody that you can have a conversation with. And it's about the relationship. Again, everybody has rates that are based off the trading of mortgage bonds. Right. Rates are only a piece of the pie. But if you can get somebody that's going to qualify you based on your risk, so that might be a determiner of different lenders too. Hey, I can make you qualify for a better loan program because I can help show that you're less of a risk than what maybe somebody else has. So if we can increase your credit, a lot of people think they just need to increase the credit score for the loan program, but no, I could increase your credit score for a better interest rate. If I see on your credit score that, you're 660 and you qualify for this loan program, this is great and this is wonderful. But if you just did this little thing here, you're going to take you up over a 700 or 800 credit score. Well, that's going to get you a better interest rate. Yeah, a better interest rate, or your mortgage insurance. And absolutely. You get a better deal.
So you can qualify.
So you can qualify, and qualify for a better rate. So,
Awesome.
Well, all it takes is a little conversation and a little working through.
Yes.
It shouldn't be intimidating at all. It's about taking the right step. And again, I know some people have gone down that road where they've talked to one or two people and couldn't make it work. But if you didn't get the guidance, it never hurts to try again.
Right. Exactly. Yeah. It's interesting. That's probably another podcast, but I've had people, because I don't discourage shopping. I mean, let's do some comparisons here, to make them feel better about the decision they're making, or to present everything in front of them so they can make an informed decision. Right. So shop it. But then the lenders all come back different. And again, it's the same credit score. It's this, so that's probably another podcast on why that happens.
Right. And I say, even when somebody comes to me, I'm not going to, I tell people, don't give them just one option. Right. When I get a rate sheet, I get several options, and there's more than one different loan program. So a lot of times I'll put that right side by side. I'll give them 3 to 4 different options on either rates or loan programs. You can go
this way,
one
you
FHA,
can go that way.
this conventional,
I love that.
5% down, 10% down. So it really is, but once I have all the pieces to the puzzle, I know how many options to give them. I don't want to overwhelm them with what ifs, because you could what if a situation to death. But if they kind of tell me what's important to them, and show me what they got or how they want to make it work. And then we can give them different rate options and programs just in one place without having to shop it too. So that's an option.
I love working through that with you, because usually when you come up with that plan, you and I discuss it first before you send it to them. And it's a game for me. Which one are they going to choose?
Which one's going to be best for them?
It's a game by the time.
And sometimes it really just is a personal choice. Some people, they have a payment. They don't want to exceed this mortgage payment. They know what their budget is. They know what their lifestyle is. Just because I say they qualify, they don't want to spend that much money.
Right.
And then some people have, they're going, okay, well, I know I have this much money in the bank, but I want a cushion. I don't want to buy a house and then be completely broke. I want to know that if I want to buy some furniture or something like that. So I don't want to put 20% down. I know it looks better on paper, but I've got a good credit score and a little bit of mortgage insurance is not that much month to month. I'd rather do that and then pay cash for my furniture. So, it's not always the right choice for everybody. That's why I give them the choices, because it depends on their situation as to what's the best choice for them. And there's no wrong choice. It's just what's best for you.
Correct. Yeah. Awesome. Well, you've given a lot of us hope out there, Darlene, because it's not cut and dry that you don't or you do qualify.
Correct.
There's a lot to take into account.
Mm-hmm. But that's what we do. That's what we love it.
I love it.
The little puzzle games and
I love it.
Yeah.
All right. Well,
one more podcast down.
One more. Another one under our belt.
So now we need some more topics too. So again, we can take this in 10 million different ways, especially when it comes to lending and information. So we'll have to think about our next topic.
We get the calls that I love your podcast. I love your podcast. But give us the calls on topics that might interest you, so we know we're talking about the right things.
Anything to encourage somebody to look into homeownership.
That's right. Absolutely. All right.
We'll see you on the next podcast.
We'll see you on the next one.
Coffee and Keys is brought to you by Darlene Kemp, VP, Senior Loan Officer, NMLS ID 173897. Atlantic Coast Mortgage, LLC is an equal housing lender. NMLS ID 643114. www.nmlsconsumeraccess.org. And Crystal Jacques, Realtor for both RE/MAX Allegiance, 4000 Virginia Beach Boulevard, Suite 164, Virginia Beach, Virginia 23452. Office phone 757-490-7300. And RE/MAX Professionals, 20,241 North 67th Avenue, Suite A1 Glendale, Arizona, 85308. Office phone 623-362-3000. Each office is independently owned and operated and supports the Fair Housing Act and Equal Opportunity Housing.